What's going on with another impromptu video, guys? As we come into a new year, everyone is wondering, how is the markets doing? How's our business going to be doing in 2025? Everyone has opinions, everyone has speculations, but let's just kind of dive in and see what the numbers are saying. So, going to go over together with you all Indeed's latest 2025 US jobs and hiring trends report. A lot of really cool things here, and happy to kind of dive in with you and also just share with you my thoughts as we kind of go through this together. So, a couple key points here. So, the balance of current economic indicators suggest continued labor market resilience in 2025. Sounds very optimistic. Economic soft landing is coming into view, but sticking it will require careful navigating around emerging headwinds, including a slowdown in hiring and looming labor shortages. We have a slowing labor force growth and aging population, and expected decline in immigration, suggests that the supply of overall workers will weigh heavily on the job market in coming years. We also got posted wage growth has leveled off at a healthy pace, suggesting continued robust competition for workers. And of course, the widespread use of Gen AI tools promises to boost productivity, but adoption will still need to spread beyond a handful of power using sectors. So, not going to read through the whole article with you, just going to kind of skip through some parts that I find really interesting. Before we get into it, they have this section where they say that as we enter 2025, several really important data points and trends will tell us where we are in relation to the ground and how far we've got to go. So here's what to expect according to Indeed's research. What they consider a soft landing in 2025. It's neither amazing, but it's also neither terrible. So, number one, hiring and quitting cannot fall, right? This needs to be steady, and unemployment and layoffs cannot rise. After declining to the lowest levels in a decade, hiring and quitting needs to stop falling and start stabilizing, or better yet, gradually improve, which is what all of us recruiters, agency owners are hoping for in order to avoid a rough landing. At the same time, unemployment and layoffs need to remain at or near the current low level. So, what's really interesting about this is in the US, the past 12 months, everyone's been yelling, we're in a recession, the economy is terrible, the economy is terrible. Yes, it's been hit hard, but on the whole, the hiring market has been relatively stable. And as we come into 2025, it's not, again, amazing, but it's not as bad as people would hope, right? So there's still a lot of activity, there's still a lot of companies that are hiring. But again, what this first point claims is definitely true. Like the hiring and needs to remain leveled, and unemployment layoff cannot have like a really unexpected spike. A pickup in job growth will depend on a pickup in job openings. Employer demand, in other words, job openings and postings, and monthly payroll gains will also need to stabilize or begin picking up. Substantial declines below pre pandemic levels could signal a broader economic slowdown. So this is something again that we study very carefully. We understand in our market how many openings and postings are there. Is this increasing? Is it stable? Is it decreasing? Employers must figure out how to do more with less. The US will have to find a way to overcome the short and long-term impacts of dwindling labor supply as the population ages and immigration returns to pre-pandemic trends. Wage growth and inflation must strike a tricky balance. It needs to stabilize or near current levels to preserve real income gains. Gen AI tools, which are becoming more and more prevalent and top of mind in terms of discussion, are starting to meaningfully boost worker productivity. Growing generative AI adoption could serve as a critical productivity booster and may offset some labor shortages. Employers must continue to embrace flexibility, a growing focus on reducing degree and experience requirements, boosting skills based hiring practices. May provide another path to address labor supply challenges. So, my main takeaway from this specific kind of high level summary is that we just don't know what's going to actually happen, but it's neither extremes, neither really bad or neither really, really good. It's kind of still level, and it really, at worst case scenario, needs to remain level and stable, or hoping, fingers crossed, it gets better, right? Now, let's kind of dive into more of these things in a deeper dive. So as you can see here, the U.S. economy is solid, but there's little room for continued softening. So overall, things are looking pretty decent for the U.S. economy. The labor market continued to cool this year, but unemployment and layoffs remained reassuringly low, which is really, really good. Wage growth exceeded the rate of inflation for much of the year as inflation continued to retreat, leading to increased real spending power for many workers. Real GDP growth clocked around 3% over the last 2 quarters, and consumer spending remained solid. So, as you can see here, one of the clearest indications of a cooling labor market has been the ongoing pullbacks in job postings. That means overall companies are hiring less or at a slower pace from their March 22 peak levels, which is right here. As of November 24, the Indeed job post index was down 10% over the year, though still 10% above pre-pandemic levels, right? Which was still just horrible. Federal job openings data reflect a similar trend, with official openings standing 11% above February 2020 levels on the last business day of October, despite cooling from last year. While these data reflects continued employer demand and resilience, we are approaching a point where further cooling may begin to translate into rising unemployment. So ideally, we want this to remain steady here and not continue to dip down into what we call more like just red flag areas, right? This is kind of the dotted line here, but you can see there's been a steady decrease in. It's not just job postings, there are of course other economic and financial variables that are affecting this as well. But this is just a really good visual to see. Now, if you are a recruiter, this is no need to panic or to just be like, oh my God, recruiting's going to die. Overall, things are relatively healthy. We just need to be very, very cognizant of what's going on. Okay, according to, and this is another really cool chart. Another sign of labor market softening has been slowing job gains, right? Which is what we're seeing here, this overall downtrend. In 2023, the economy added an average of 251 jobs per month, well above the pre-pandemic pace of 166. That average has fallen to 180,000 jobs through the first 11 months of 2024, which is above roughly the 100,000 a month pace needed to keep up with population growth, well below previous year's clip. So to achieve a soft landing, payroll gains must continue to be robust enough to keep up with population growth to meet the Federal Reserve's goal of full employment. So as you can see here, 2021 and 2022 was popping. I mean, I remember those days, it's so easy to get new clients. It's so easy to get new jobs because companies are hiring in abundance. But from 2022 onward, as you can see, we just have been a gradual decline with couple spikes up here in late 2022, 2023. We got 1 or 2 months here, but then overall it's still relatively low. A smooth landing will also require more broad-based job gains next year, in addition to the slowing overall job-based creation. These jobs have been added in 24 have been primarily concentrated in just 3 areas: healthcare, socials, and government, leisure, hospitality, which combined represent almost 75% of all jobs added in the last 12 months. So you're asking me which sectors are hot. According to this data, it is in these 3 sectors. Now, this is something that I find really, really cool. Hiring and quits are near decade lows. So the pullback in hiring has been even more pronounced among other industries. So as of October, hire rates were below pre-pandemic, which is not good, in 9 of the 13 major industries defined by the federal government. The information, tech, and construction have experienced the largest drop in hires rate, with the rate in each currently below pre-pandemic levels by a percentage point or more. And for someone who has an agency that's predominantly focused in tech, boy, oh boy, and I'm sure if you guys have experience recruiting in tech or they're in tech or you guys are corporate internal recruiters at tech, slowing has almost felt like it went to a complete halt. And it's just been frustrating. It's been painful. And I just hope that we can kind of continue to stabilize here and hoping that we hit the bottom and there's only one way up here, right? But despite a slight pickup in recent months, slower industry hiring in 2024 has led to the lowest overall hires since 2013. The hire rates fell to a recent low of 3.3% over the summer, bounced back to 3.5, and then returned to 3.3. So looking ahead, hiring will likely remain lower in past years, but the recent upward trend is an encouraging sign that things might be picking back up. So to stay on the glide path towards a soft landing, we would ideally see the rate gradually climb back towards or even match its 2019 average of 3.9%. So let me just zoom in here and check this out. So the blue is February 2020, October, red is 2024. So for mining and logging, you can see that they've been an increase in hiring from 3 to 3.2. Private education has also increased, and other services has also increased from 4% to 4.2. Now, transportation and warehouse sectors, it actually decreased to 4.2%. We got another decrease in manufacturing, government, and wholesale trade all decreased. Look at this. Professional business services is a significant decrease for almost by a whole point here. Leisure hospitality got slammed, obviously, which is, man, that's a huge, huge swing there. Same with retail trade, financial activities, construction, and information. So obviously, tech, leisure hospitalities, retail trade, financial activities, information all got slammed really, really hard. But as you can still see, there are still other sectors here that are continuing to show a little uptick in growth. Just to kind of end this slide here. So quits are also a good indicator of labor market dynamics and job seeker confidence. Workers tend to feel more comfortable quitting when they are confident in their ability to find another job, right? So declining quit rates can be concerning as it might reflect lower enthusiasm for job seekers. After rising dramatically during the so-called Great Resignation in 2021 and 2022, the quits rate began a steady descent in line with the pullback in hiring and job openings. In September, the quits rate reached its lowest since July 15 at 1.9%. While some of the recent decline in quits may reflect some levels of content among workers, it's likely that the pullback in job postings, especially in knowledge work sectors like tech, is weighing on the job seekers' confidence as we head in 2025. And boy, oh boy, does this ring true. We're seeing a lot more people are just less trigger happy to get a new job, even though they might be really unsatisfied at their current job, because the fear of not having a job versus having a job that you don't like, that is scaring a lot of people just to kind of stay put. And the fact that there's just less job openings out there, less companies that are hiring out there, also due to like the humongous supply of tech talent on the market still, because of the layoffs that are still ongoing, is just making things a tough time. But again, this is just very focused on tech. But as you can see from this data, other sectors continue to grow in terms of the percentages of the higher rates. So as you can see here, the quit rates here is below its pre-pandemic levels, which it was referring to. So it kind of dropped a lot, and then it rised above this 2019 average here to 2021, 2022, but then it's now below, but we have seen an uptick here. Hopefully that could be a sign of the economy shaping up. Overall, the unemployment rate, guys, is remained and layoffs remain low. The outlook for job seekers and workers is not all bad. So let's talk about more good news. So according to recent unemployment and layoff statistics, so despite a handful of public layoff announcements in the tech, unfortunately, overall layoffs remain subdued. So in October, the layoff rate clocked in at 1%, a tenth of a point below the pre-pandemic, while unemployment crept up in 2024 from 3.7 to 4.3% in July. Much of that increase was a result of new and returning entrants into the labor force, a sign that while the market remains strong enough to continue to draw people in, it is no longer strong enough to get those new entrants a job as quickly as a few years ago. Absolutely, we're seeing this. And again, I can speak loudly about tech. A lot of other industries are also doing layoffs, but just I know my industry, it's painful. The amount of layoffs at scale has just been so heartbreaking to watch. But since peaking, the unemployment rate has decreased slightly to 4.2%, a rate largely on par with healthy pre-pandemic levels. Unlike other indicators, this has a little wiggle room and could tick up a bit without immediately jeopardizing a soft landing in 2025, especially if more labor market entrants drive the rise. Even an increase in unemployment to around 4.5 would keep the rate still historically low. However, things can get more concerning if there is a sustained increase in the number of permanent job losers. So as you can see, my goodness, the unemployment rate shot to almost 7% here, and then it fell really, really sharp in 2022, but from 2022 onward, it's been just a gradual uptick. Now, we have seen like a slight rise here in 2024. It is decreasing. My hope is that it just remains consistent. Hopefully, minimum or even better, it starts decreasing. We don't want things to uptick or go in the other way drastically. With all that said, according to them, the economy is well positioned to handle headwinds heading into 2025. The labor market and economic data presents a mixed picture. Signs of cooling, including the decline in job postings, slower hiring rates, and pullbacks and quits, suggest that the labor market is approaching concerning territory. Key sectors like healthcare, government, leisure, which have supported much of the growth, may also face headwinds as well. But despite these worrisome trends, there's also several indicators of resilience, including a robust GDP growth and consumer spending that might kind of provide an alternative argument here. Job postings remain above pre-pandemic levels, which needs to stay where it is. Unemployment remains low, and wage growth continues to outpace inflation. The Federal Reserve's recent rate cuts show that policymakers are throwing more support behind the labor market, with more cuts expected in 2025. So right now, the indicators lean towards a continued labor market resilience and the possibility of a soft landing rather than a sharp downturn. But despite the uncertainty of a new presidential administration and economic demographic headwinds, it's well positioned, hopefully, to handle it really, really well. Now, you can, of course, read this for yourself. I will include the links. You can see a couple other really cool things. The job postings remain 10.2% above the pre-pandemic baseline. Again, we want to remain a soft warning or landing territory. We want this to stabilize as much as possible. But this is something that I want to end it with. So the decline of job postings over the past year is broad-based, but of the 52 total job categories regularly tracked by Indeed, only 7 notched a year-over-year gain in postings. Most categories across the labor markets are in decline. The lack of healthcare jobs as a bright spot in the labor market is a bit departure. Throughout most of the labor market slowdown, healthcare, including physicians, surgeons, and therapy, were still adding job postings at a slower pace. So check this out. And this is what a lot of recruiters, agency owners would want to see. What are the largest gains and declines in job postings, year over year change? So the top 5 winners are chemical engineers, beauty wellness, sports, logistics, and banking. I personally know a lot of people who own agencies in the kind of life and science, the engineering space, in addition to logistics and banking and finance. And I also know people that are just really struggling in electrical engineering, industrial as well. So as you can see, these are like the biggest kind of declines and the top gains, but this can change drastically year after year, or year after year, month after month specifically, and week over week. But this can kind of show you just a good snapshot of like what is moving and what's not moving. But again, things can be subject to change, and the whole the takeaway I want you to have from this is we just need to be cognizant and aware of what could happen. Now, there's a lot of other really great stuff here. It goes over prime age, foreign job seeker interest, compensation, wage growth is slowing, inflation is trending down, posted while posted wage growth stabilizes. That's of course a great thing. We want inflation to continue to go down while wage growth stabilizes. More and more really great stuff here. What is it? The share of job postings with benefits has moderated. Another important thing is that remote postings decline regardless of job mix. This is something that is not surprising. More and more companies are pulling back on the remote postings, which means that it's going to be even more of a heightened competition for talent locally in the market, wherever that company is located. But I still see a lot of healthy hybrid and also fully remote job opportunities in my sector. That may change in yours. And if you see anything different, please comment down below. We'd love to also hear what you think as well. But all in all, guys, this is a fantastic article. It kind of ends here saying that Gen AI is growing but needs widespread adoption for a strong economic impact. But you can see the numbers speak for itself. It's just boom. It went super up, almost in a parabolic phase. And they're saying that while Gen AI have many benefits, they also have a lot of upfront costs to both to implement and train staff. Majority of the sectors with the highest share of postings mentioning Gen AI are also known for creating, implementing new tech, most likely to be involved in developing Gen AI tools themselves. So that's still TBD. Shares of postings mentioning Gen AI by sector: mathematics, engineering, IT, architecture, marketing, with the lowest being sales, accounting, medical information, and so on and so forth. So I hope you guys enjoy this. But just to conclude, the article says that after navigating significant turbulence, including elevated inflation and recession fears, the economy appears well positioned to make a soft landing in 2025. But hey, we still have to be cognizant. While the current speed and direction of the economy are providing significant momentum, further slowdowns in hiring and labor supply growth may prove more difficult to navigate. The degree to which these headwinds drag on the economy will depend on how policymakers choose to pilot the plane and what policy objectives they pursue next year. And lastly, what could this mean for job seekers and employers? It's shaping up to look a lot like the second half of 2024. Again, not too hot, not too cold, somewhere in the middle. Absent a meaningful uptick in job openings and postings, finding a job could be trickier moving forward, especially next quarter or two in 2025 than it was during the hiring surge of 2021. especially in knowledge work sectors like software development, marketing, and media, where employer demand remains low. But there's still plenty of pockets of opportunity for job seekers, and competition for workers is likely to stay strong for employers. So, guys, I hope you really enjoyed this. I think the biggest takeaway I've learned from this is that a soft landing, even though that doesn't sound exciting, is actually a good thing. We ended 2024 off on a pretty solid note here, and we expect 2025 to continue to do really well. The agencies that I know, the friends I know, the students in our program here are still picking up clients consistently. And that's what you need to do to make sure that your desk, your business remains healthy. But we want, and we all got to pray and hope that things just remain stable and at the bare minimum, and hoping for an uptick in the right direction if it goes. So there's still a lot that can happen economically wise. We could still, go into a surge of the markets here, even hoping to have more of a ripple down effect with the job and hiring market. But I still do personally feel a lot of these conclusions that the article is stating, a lot of really great talent that's struggling to still find great jobs in tech and other industries. Even though companies are hiring, it's at a slower pace. But again, I do not expect this to be forever thing. We just don't know how long it's going to last. And we just got to hope, guys, it's not going to go down into the wrong direction. We stabilize here. Hopefully, we're bottoming out and remain optimistic into the rest of this year. But I hope that this helps. If you want to see more market videos like these, please comment down below. I think that's really important for us as recruiters, job seekers, business owners to be aware of what the numbers are saying so that we can make informed, better decisions for our business. So I appreciate it. Hope you have a great day, and we'll see you on the next one.